All right, let's jump right into this explainer. Today, we're unpacking the sheer mystery behind one of the most fascinating financial empires in human history. Seriously, how does a guy who prefers a quiet life in Nebraska over the towering, flashy skyscrapers of Wall Street manage to build a trillion-dollar fortress? Let's find out.
Now, what's truly staggering about this $1 trillion valuation is that it belongs to a company with absolutely no defining technology, no singular flagship product. I mean, in an era where tech behemoths completely dominate the headlines with algorithms and AI, this massive conglomerate achieved its monumental size just by quietly owning the everyday nuts and bolts businesses that make the world run.
So how exactly did a failing textile mill become a trillion-dollar empire? To answer that, we really need to unravel the paradox of a CEO who controls global markets, yet completely ignores the high-flying, fast-paced ways of Wall Street. It's this incredible story of compounding value, crazy emotional discipline, and a totally unique way of looking at numbers that turned a doomed manufacturing plant into an unprecedented wealth-generating machine.
And honestly, nothing illustrates the duality of Warren Buffett quite like this contrast. On one hand, you have a financial titan capable of bailing out massive banks during global meltdowns. On the other hand, you've got a guy who still lives in the exact same house he bought over 50 years ago for just over $31,000. A guy who notoriously pays for his daily McDonald's breakfast with exact change and washes it down with several cherry Cokes a day. It's exactly this grounded, folksy nature that fuels his cold, highly rational business logic. It's a pretty stark reminder for all of us that ultimate success absolutely doesn't require a flashy lifestyle.
Section 1. The Doomed Textile Mill. From racetrack stubs to Berkshire Hathaway.
Let's trace this all back to the raw materials of his success, a boy growing up during the Great Depression who was just utterly obsessed with numbers. These early ventures proved he was totally wired for business, long before he ever stepped foot in a boardroom. I mean, while other kids were out playing, young Warren was devouring the World Almanac, memorizing city populations just for fun. He was out on the golf course finding lost balls to resell, sweeping up discarded racetrack stubs hoping to find a winning ticket, and running a remarkably profitable newspaper delivery route. By the time he finished high school, he'd already amassed a small fortune of $5,000, purely through relentless compounding hustle.
Learning from his Columbia professor, the legendary Benjamin Graham, Buffett initially hunted for deeply undervalued, completely discarded companies. It was a strategy that led him to hunt for what he famously called cigar butts, companies thrown away by the market but with just enough left for one free, slightly unglamorous puff of profit.
And, well, this approach led him straight to a doomed asset. The management of this failing textile company actually tried to short him on a verbal buyback agreement. Instead of just walking away, Buffett got mad. He bought enough stock to completely take over the company and promptly fired the manager. Suddenly, he was the proud owner of a terrible business in a dying industry. The big takeaway here? Sometimes your greatest empire begins with your absolute worst mistake.
Section 2. The Insurance Float's Secret, Fueling the Engine.
Realizing textiles were basically dead, he extracted the mill's cash and discovered an absolute financial magic trick. Now, we all know what float is, but Buffett realized it wasn't just operational cash. It was a massive, continuous, interest-free loan to buy other businesses. See, unlike borrowing money from a bank where you're slapped with hefty interest rates, an insurance company actually gets paid by its customers up front, and until a claim is filed, that giant mountain of cash just sits there, waiting to be deployed.
So here's how this unstoppable money machine actually works in practice, providing the incredibly cheap capital needed to fund a massive buying spree. First, you collect the premiums. Second, you hold those funds. Third, and this is really where Buffett's genius shines, you invest that float into highly profitable, rock-solid companies. Finally, you pay out claims much later using the new cash flows you've just generated. It is quite literally the ultimate financial engine.
Section 3. Moats and Monopolies. Buying Greatness.
Armed with this endless supply of capital from the float, Buffett completely abandoned the cigar butts. He realized a profound truth. It's far better to buy a wonderful company at a fair price, provided it has an economic moat. For him, it wasn't just about profit margins, it was about having an impenetrable protective barrier against competitors. Whether that's an iconic brand, a total monopoly on a service, or an irreplaceable piece of infrastructure that basically guarantees long-term dominance. From simple chocolates to incredibly complex railroads, these acquisitions perfectly highlight his strict criteria for enduring competitive advantages. Take See's Candies, for example. People love the brand so much, they willingly pay a premium, which gives Berkshire incredible pricing power. Or look at BNSF Railway.
I mean, nobody is building a brand new competing transcontinental railroad tomorrow, right? The physical infrastructure is simply irreplaceable. And Apple, the unmatched consumer loyalty and dominant brand strength made it one of Berkshire's most profitable investments ever, which is wild considering Buffett traditionally avoided technology like the plague.
Moving on to Section 4, the operating system, principles and character. Now, acquiring businesses is only half the secret. The other half is his fierce, entirely uncompromising character. Enter the terrifying 1991 Salomon Brothers crisis. Basically, a rogue trader illegally cornered the U.S. Treasury bond market, and the government was ready to issue a death blow that could have sparked a total global financial meltdown. Buffett actually stepped in as CEO over a frantic weekend, risking his entire personal standing to successfully beg the U.S. Treasury for a stay of execution. Thankfully, by the time Tokyo markets opened, catastrophe was averted. Because of an earlier, pretty bruising SEC probe into a company called Wesco, Buffett became obsessively strict about proper behavior and ethical management. That early investigation truly terrified him, and he emerged with a steadfast dedication to protecting his name at all costs. This philosophy right here, it isn't just a catchy phrase for him, it's a vital corporate shield, and a really potent reminder for any professional today about the absolute fragility of trust.
Section 5. The Buffett Principles.
This deep dedication to integrity naturally evolved into a strict set of rules, which is beautifully captured by his legendary maxim, "Be fearful when others are greedy, and greedy when others are fearful." It's the ultimate display of emotional discipline. It allows him to wait patiently while others panic or wildly speculate. When the market is booming, he just lets cash pile up. But when a crisis hits, like the 2008 financial crash, Buffett is the one out there aggressively buying up incredible assets at bargain basement prices.
These 5 simple, yet incredibly rigid principles form his architectural blueprint. He stays strictly within his circle of competence, meaning he only invests in what he deeply understands. He demands true value. He removes emotion completely from the equation. His absolute favorite holding period is literally forever. And importantly, he doesn't micromanage. He buys great businesses, hires honest managers, and then just gets entirely out of their way.
Section 6. Life after Warren. The legacy.
So as we look past the decades of historic stock market returns, what actually happens to this massive empire when its architect is gone? Well, first, it starts with a massive paradigm shift in his wealth. Following the tragic loss of his first wife, Susie, Buffett made history by pledging the bulk of his fortune to the Gates Foundation rather than passing it down to his heirs. It was honestly the perfect solution, letting highly energetic people allocate his wealth to solve the world's most pressing problems, all while he got to keep doing what he loved every single day in Omaha.
And despite his singular fame, he purposefully engineered Berkshire Hathaway as a decentralized fortress, totally capable of weathering economic storms without him at the helm. It's definitely not a fragile house of cards. It's built on entirely independent units that fund themselves. He has put incredibly competent, hand-picked successors in place. They have tens of billions of dollars in insulating cash reserves to handle literally any crisis. And they are woven deeply into the very fabric of the global economy through vast diversification.
But as the global economy undergoes rapid technological shifts, the ultimate test for Berkshire Hathaway is going to be whether this old-school secret recipe can actually conquer the future. We are moving headfirst into an era of artificial intelligence, rapid automation, and unprecedented digital disruption. So, will patience, emotional discipline, and a strict focus on economic moats be enough to sustain a trillion-dollar valuation when the fundamental rules of the game are changing? It's a fascinating question. And watching how this legendary corporate fortress adapts in the years to come, well, that's going to be the ultimate masterclass in business.
If you like this video, like, share, and subscribe to Wealth Decoded for more of our business, finance, and tech explainers. Turn on the bell to get notified when a new video is uploaded. Thank you for watching, and we will see you all in the next one.